Welcome to e-Adhyayan Today we will talk about adjusting journal entries. Now, journal entries are recording of financial transactions in the business, and adjusting journal entries are supporting journal entries that helps in showing the true and fair view of the business at the end of a financial period. We will talk about different types of it. We will define them and also give examples so that we can understand it better. So let's get started for the day. Now let's look at the definition of adjusting journal entries. Okay, it says it is a special journal entry made into the books of the business at the end of a financial period to show the true and fair view of the business finances. Okay, so let's break it down. A special journal entry, I'm highlighting this, a special journal entry made into the books of accounts of the business at the end of a financial period, okay, to show the true and fair view of the finances of the business. That is, these are the special types of journal entries that we are doing in our books at the end of a financial period so that we can show the true and fair view of the business. Okay, these are the supporting journal entries. Okay, supporting journal entries means that apart from the actual journal entries that are taking place in the business, to show the true and fair view of the organization, we are using these supporting journal entries at the end of a financial period. The next one says that it backs up the accrual and matching principle. That means accrual means that the transactions that should have happened within a financial period, irrespective of whether the cash is moved or not. So it backs up the accrual principle and matching principle, that is matching the expenses with relevant revenues they help to earn in the same period, in the same financial period. And the third one says that it shows the actual cost and actual revenues. Absolutely, that is that at the end of a financial period we are looking at the actual cost or the actual expenses made by the business and the actual revenue that has been earned by the business. Okay, so this is all about the definition of adjusting journal entries. Now we will move on to the different types of adjusting journal entries. The first type of adjusting journal entries is accrued or outstanding expenses. It states that expenses might be incurred but the actual cash expenses is yet to be made. Let's break it down. Expenses might be incurred. What do we mean by incurred? Incurred means that the obligation of payment has already been made, that the employees have already fulfilled their part. They have played their part, but we are about to pay them for that. Okay, so the expenses might be incurred but the actual cash expenses is yet to be made, that the actual cash expenses that we have to do, okay, that is yet to be made. So if we take an example for this, it will be outstanding salaries, that the employees have already played their part but we haven't paid salaries to them as of now. So I am writing here outstanding salaries. Okay, now if you see, the journal entries are already given. Okay, so let's look at that. The first entry, that is recording the unpaid expenses at the end date of our accounting period, okay, keep in mind at the end date of our accounting period that we are recording the unpaid expenses, that is the expenses account debtor to outstanding expenses account, okay. Second entry is when the cash is actually paid by us will be outstanding expenses account debtor to cash or bank account. Now if we see that the original journal entry would have been expenses account debtor to cash or bank, now that we are not paying them as of the last date of our accounting period, outstanding expenses account is here. Also, to eliminate that account when the cash is actually being paid, we are debiting it here through the cash or bank account. Now I will take a real life example so that you can understand it better. Now we have taken a real life example of outstanding expenses, okay. It states salaries outstanding to employees of rupees 6,000 on 31st of March 2025. So on 31st of March 2025, the outstanding salary to employees is rupees 6,000. The outstanding was settled on 6th April 2025. That is, the outstanding has been paid to the employees on 6th of April 2025. Now you see, at the end of the financial year, that is 31st of March 2025, we will record the unpaid expenses. Now the expenses account here is salaries account. So writing it down, salaries account, okay. Salaries account debtor to outstanding, again here outstanding salaries, okay. So at 31st of March 2025, the journal entry is salaries account to outstanding salaries, that is rupees 6,000 each, okay. Now at the end of the financial year, we have created outstanding salaries, that is a liability to the business because the business has to pay it, okay, but it hasn't paid so far, so it will be shifted to the current liabilities, okay. So as of 31st of March, the outstanding salaries will be treated as the current liability of the business. Moving on 6th of April, the actual payment has been made. Now on the 6th of April, the simple thing that we'll do is that the outstanding salaries that has been credited before will be debited now, okay. So I'm writing it here, outstanding salaries account debtor to cash or bank, okay. So it will be also 6,000 each as well. Since there is no space, I have written it here, okay. So this is the real life example and the journal entries of outstanding expenses. Now the second adjusting journal entry is prepaid expenses. It states expenses paid in advance, but the benefits will be consumed in future, okay. Let's break it down. Expenses paid in advance, that means that the expenses are made way before it is being due, that you have to pay something on 1st of March, but somehow you have paid that on 1st of January, okay. It is some sort of a scenario like that, but the benefits will be consumed in future. Future means in future accounting periods. So if we can sort it down, it means that that are certain sort of expenses that you have made in a particular date from which the benefits will be consumed for more than one accounting period. That is called prepaid expenses. Now, if I have to give an example, it would be insurance premium paid in advance. Okay, it can so happen that you have already paid the insurance premium of 2026 along with the insurance premium of 2025 on 1st April 2025. Now in that scenario, we are already paying the insurance premium of the year as well as the next year. So that will be a situation of prepaid expenses. Now if we see the journals, that the first journal entry will be the recording of advance expenditure. Okay, that would be prepaid expenses account debtor to cash or bank account. Okay, now this one is interesting. The second journal entry says that consumption of the expenditure. Okay, so here you might have paid the expenditure for 2 or 3 years, but here at the end of the financial period you only have to show that part of the expenditure from which the benefits has been sought in this financial year, not the next ones. Okay, keep that in mind. Now we will take an actual real life example so we can understand it better. Now the real life example on prepaid expenses. Okay, it states annual insurance premium is rupees 4,000. Business paid rupees 8,000 as insurance premium on 1st of April 2024. The annual premium due was rupees 4,000, but the business paid rupees 8,000, that is 2x of it. Okay, now if we see the journal entries, the first journal entry will be recording of the advance expenditure. Okay, now the expenditure is made on 1st April 2024, that is rupees 8,000. So prepaid expenses will now change to prepaid insurance premium. So I'm writing it down. Prepaid insurance, prepaid insurance premium account debtor to cash or bank account. That would be the exact amount that has been paid by the business, that is 8,000. Now at the end of the relevant accounting period, that is 31st of March, okay, only the expenses of this year will be shown there, that is rupees 4,000. Okay, so now the expenses, that will be the insurance premium, I'm writing in short, insurance premium account debtor to the amount of this year only, that is rupees 4,000, to prepaid expenses, also to be changed as prepaid insurance premium 4,000. Now you see that the original expenditure was rupees 8,000. We have shown rupees 4,000 because that is the expenses of this accounting period. Now the remaining figure, that is 8,000 minus 4,000, that is 4,000. that is the advance that we have paid. Okay, the advance that we have paid, from that the benefits will be consumed on the next accounting period. So that 4,000 rupees, okay, that 4,000, that is 8,000 minus 4,000, this 4,000 of advance insurance premium paid, this 4,000 will move to the current asset side, because the benefits from this 4,000 will be incurred in the next accounting period. So for this accounting period, this is a asset for my business. So this is the real life example of prepaid expenses. Now we will talk about the third adjusting journal entry, that is accrued income. It states that income has been earned, but the actual cash is yet to be received. Now if we break it down, income has been earned. Here earned means that you have provided the service or the goods to the consumers, or you have invested or held capital, but the actual cash is yet to be received. But for delivering the goods or services, or for holding or forming the capital of another business or financial institution, the actual cash that you should have received haven't received as of now. It is yet to be received. Those types of income are called accrued income. Now if we have to give an example of it, let's say interest income. Okay, so I'm writing it down here. Interest received, okay, or we can say dividend received. That as of the last date of your financial period, the income should have been received, that you have already earned it, but the actual cash has not been received by you. It is yet to be received. Okay, the journal entry in this case, the first journal entry will be the recording of the earning. Okay, now you see, if the earning has been actually received by you in cash, in that case the transaction would have been cash account to income account. Okay, but the fact that you have not received in cash would change the scenario. So the first entry, the first journal entry of recording the earning, the accrued income, is accrued income account debtor to income account. Okay, now when you will be receiving the actual cash, the journal entry will be cash account debtor to accrued income. Okay, now we will take an actual real life example so that you can understand better. Now we will look at a real life example of accrued income. Okay, A Limited has a term deposit of rupees 1 lakh at the rate 10% interest per annum to be paid annually on 31st March every year. Paid interest of 202526 on 6th April 2026. So A Limited has a term deposit of rupees 1 lakh that gives 10% annual interest. But in this year, instead of 31st of March 2026, it paid interest on 6th of April 2026. So now in this case, on 31st of March, the income is actually earned, but the actual cash income is not received by the business. So we will see the journal entries. On 31st March, we will first record the earning, that is rupees 10,000, because if we calculate 10% interest on 1 lakh, it will be rupees 10,000. So first of all, let's change the account. Here it will be accrued interest account. Okay, so I'm changing it. Accrued interest account in short. And now the income will change into interest income account. Okay, so in the top I am writing of income in short, that is accrued interest account debtor to interest income account, that is rupees 10,000 each. Okay, now you see on 31st of March this income of rupees 10,000 is already earned by you, but the actual cash is yet to be received. Since the actual cash has not been received by you so far on 31st of March, this accrued interest part or the or rupees 10,000 on accrued interest will move to the current asset. Now you see that the 10,000 part that should have been earned by you, I mean the actual cash income should have happened on 31st of March, but since it has not happened and it is an income to you, okay, a revenue to you, we are moving that to current asset, that the income will be received by us in the future. That is why it is an asset. Now moving on 6th of April we have actually received the cash. So on that day, you see, if bank is paying the interest, it will not be cash, it will be bank. Bank will directly pay to your account. So bank account debtor to accrued income. Now accrued income becomes accrued interest. Okay, that is again 10,000 each. Now the moment you will receive this amount, this accrued interest part will be removed from the asset side, because the income, the actual cash income is already received by you. So there will be no balance left on accrued interest in the asset segment, so it will be removed from the asset segment. Okay, so that is a real life example of accrued income. The fourth adjusting journal entry is unearned income or income received in advance. Okay, it says actual cash has been received but it is yet to be earned. So it's a reversed situation than the last one. The actual cash has been received by us, but it is yet to be earned. Earned means that the goods are not delivered by us yet, or the services are not rendered by us as of now. But before the delivery of goods or the rendering of services, the advance income, the advance actual cash income has already received by us. Okay, this is the scenario of unearned income or income received in advance. Now if you see, an example of this would be rent received in advance. Okay, so I'm writing it down. Rent received in advance. Okay, now if you see, the first journal entry in this case would be the recording of the advance income, that is cash account debtor to income received in advance account. Okay, here I have missed 2, so I'm writing it down. cash account debtor to income received in advance account, and when the goods will be delivered or the services will be provided by us, then the journal entry will be income received in advance account debtor to income account. Now to understand it in a simple way, we will take a real life example. Now we will see a real life example of unearned income. Okay. Rent per annum is rupees 12,000. Mr. A paid rupees 24,000 on 1st of April 2025. Now we can see that the annual rent is 12,000, but he paid rupees 24,000, that is 2x from the annual rent. So first of all, the first journal entry that we will do, that on the day of receiving the advance income, that is 1st of April 2025, the journal entry will be cash account debtor to income received in advance. It will change to rent received in advance. I'm writing it down. Rent received in advance, that is rupees 24,000. The actual amount that has been received on that day. Okay. Now at the end of the financial year, we will only show the relevant part of the expense from this 24,000 advance we have received. The relevant part for this year is rupees 12,000. So we will say that, not income, again, rent received in advance, rent received in advance, the relevant expense of this year, that is rupees 12,000, rupees 12,000 will be shown from not income account but the rent account. Okay, so at the end of the financial year, the journal entry will be rent received in advance to rent account, that is 12,000, the relevant rent for this annum. Now you see that the 24,000 has been received from Mr. A, but only 12,000 is relevant for this year. So this additional 12,000 or the advanced income that we have received, or the income received in advance, is an obligation for me, because I have received the income but I have not provided the benefits of it. Since I have received this income and yet to provide the benefit of it, this 12,000 then goes to my current liability. Okay, since this becomes an obligation that I am yet to fulfill, this goes to the current liability. Okay, so that is a real life example of unearned income or income received in advance. Today we have discussed about adjusting journal entries. We understood outstanding expenses, prepaid expenses, accrued income and unearned income through definition, examples and real life examples along with the journals of them. I hope I have helped you understand the adjusting journal entries in a simple and better way. I hope to meet you soon. Thank you.